Good afternoon, everyone. Thank you for joining us today. We'll just give it a couple of more minutes because we're seeing people still join in, and then we'll begin with the webinar. Okay, thank you everyone for joining in today. We're really happy to be doing this session because the inspiration from this actually has come from conversations with investors, where we've noticed that there are a lot of questions that are on everybody's minds, and they're very similar to each other, but most investors seem to be getting this run of the mill or standardized kind of response to these questions. So we thought we could have a more curated conversation where we are talking about these common questions, and we're going to give you slightly different perspectives with respect to their answers. And it's a short presentation. So what our intention is also is to have a conversation with you all. So whatever questions that are there on your mind, anything that comes to mind while we are having this discussion today, you could please type that in the chat box, and we'll be happy to take it towards the end of the session. So, thank you again for spending 1 hour of your weekend with us to talk about wealth creation and look at what fixed income investing is all about. And without further ado, let me begin on the presentation. So, the first question that everybody seems to be asking us now is whether it's a good time to really invest in debt, right? Is it a good time to look at a safe investment? Is it a good time to look at fixed income? So this is something that a lot of investors have been asking, and there's good reason because for a long time we've been used to seeing fixed deposit rates almost from 2017 at 6%, 5%, 4%. Those are the kind of returns that investors got used to. And now you're at a better number today. So naturally, this question will come to mind, right? And when we look at the answer, I think we need to split it into what else are your options, right? Is it a good time to invest in debt? Traditionally, all of us as savers look at gold, real estate, equity, as well as fixed income as four potential investment options. Now, when we look at gold, it has done really well in the last 1 year. And in the last month or so, like you've seen it touch all-time highs. So can we be 100% sure about investing in gold in a blind manner? I would think that we need to exercise some level of caution. Yes, it's still a good investment, but we need to be careful about the price or the valuation at which we are making those decisions. Then the next favorite option has always been real estate. And what we're seeing is as your home loan rates are going up, the decision to look at real estate as an investment becomes costlier, which means that it's not as easy for someone to look at real estate as an investment in 2023 as opposed to when they were going to do it, say, a few years ago, especially in the COVID years when your interest rates were much, much lower. And then we'll move on to equity, which is the next popular sort of choice. And with respect to equity, um, I think this year is going to be tough in terms of market volatility. The last month or so, or rather the last few weeks have been a little more positive on the equity market, with the market showing some kind of strength, but it is still quite volatile, right? So for an investor who's used to steady, stable returns, I think this is not going to be a year where you can look at an equity investment from a performance lens. It's definitely a year where you can look at equity from a investment and participation lens, right? So that brings us to debt. Now your interest rates, just like your home loan rates, have gone up. Your In terms of the interest rate cycle, also we're closer to the peak. The signals that we're getting and the sense that we're getting from different central banks, whether it's the RBI, whether it's the Federal Reserve, is that okay, you know what? We have increased interest rates quite a bit in the last year or so. How about we take a pause and a breather to decide where we're going to go next and what we're going to do next? So um, that basically tells us that we are at a space where investing in debt is attractive because the risk reward in debt is much better than the other alternatives that are there. But even on a merit basis, so relatively debt is attractively valued, but even on a merit basis, if we look at where debt and fixed income is today, we are on a better wicket today than we were 1 year ago, 2 years ago, and probably in the last 3 to 4 years as well. If we apply a strong framework, we're going to arrive at the same conclusion. So it's certainly a good time to invest in fixed income. Now, moving on to the second question, which is a natural follow up to the first one, right? We talk about debt and we say that, yeah, okay, it's a good year to invest in debt, but there are always long term investors in the game, and they think that, okay, that sounds great, but you're looking at a 7% return. Won't equity beat debt in the long run? And this is a very valid question to ask, right? Or it's a very valid framework to apply to your investment decision process. And the answer to that is actually everybody's a winner. In each year, your performing asset class is going to be a different one. So this is a chart that shows us what were the top and the bottom performing asset classes from 2010 to 2022. And there are few observations that you can make. It's very difficult for any asset class to be in the top three positions for more than 3 years at a stretch, right? Uh, you've seen this cycle with gold from 2018 till 2020, where it was in the top three. You see a similar cycle with large cap funds from 2017 to 2019, these 3 years, or again with large cap between 2012 and 2014. Now, what you notice is that it's quite difficult for anything to remain a winner. And once you know that something is a winner, it's not always going to stay a winner. So if we look at gold again, 2018 to 2020, top of the pile. 2021, bottom of the pile. 2022, again back at the top. So a winner can become a loser very quickly. And the reverse can also happen, right? Something that's at the bottom of the pile can come back to the top in the next year. So the idea is not that you're always going to have only one winner, or in every cycle, equity is going to outperform debt. There are specific years where you'll see debt come out on top, whether it's in government securities or corporate bond or credit risk. These are all different themes that end out being high performers in different parts of the market cycle. So the idea is that you need to look at your overall asset allocation and to understand that there's not only one thing that can create wealth for you, there are multiple things. And the way you approach that with a framework based on your risk appetite, based on your goal horizon, these are things that can help you have multiple winners within your portfolio at any given year. And now moving on to our third question, which is that, okay, should I really be taking a very sort of complex approach to investing in fixed income? Or can I just stick to fixed deposits? Because it's so easy for an investor to look at a fixed deposit and understand how it works. You take your money, you put it in a bank or with an NBFC or a corporate. They agree to pay you a fixed amount of interest, and then you have a schedule also, right? So today, if you make an investment, you know that in X number of years, you're going to get this money back. Either the interest is going to be paid out to you regularly, or you're going to get all of the interest bunched along with your principal at the end. So, should you just stick to fixed deposits, or is there merit in really looking at the other products that the market has to offer today? So, one thing that every investor needs to think about is that deferring tax actually helps you create wealth. And to do this, we're going to show you an illustration of the post-tax compounded return for a mutual fund versus FDs. So for those of you who are not familiar, previously the taxation for a debt mutual fund used to be that if you held the debt mutual fund for a period of 3 years or more, you would get something known as an indexation benefit, and you would pay tax at at a rate of 20%. But today that tax rate is actually your slab rate. So whatever your income tax rate is in general, that is the tax rate that will apply to your debt investments, right? So when you have a mutual fund versus a fixed deposit, both of them are taxed at the same way, in the sense that there's no indexation benefit for mutual funds anymore. And the tax rate that you pay is your slab rate, which is the same as an FD. But the key difference here is that with a fixed deposit, you have to pay tax on your interest year on year every year. Even if you choose the cumulative option, whatever interest you're earning that year notionally, you pay tax on that amount. Whereas in a mutual fund, if you have notional capital gains, you don't pay tax on it. You only pay tax on your mutual funds when you withdraw or you redeem them. So your capital gains tax, in some sense, is deferred until the date of redemption. So how does this actually work out over a 5, 10, or 15-year horizon, right? So if you have your fixed deposit rate, uh, let's say it's at about 5.5, 5.7% today, and you're compounding like roughly if you're somewhere there, your post-tax return on your FDs is going to be like this over a period of time, right? So it doesn't matter whether you're at 5 years, 10 years, 15 years, it's the same rate that you're going to get because you pay out your tax every single year. But if you do have a mutual fund, you can see that in the first 5 years, only if you're in the highest tax bracket, that is, the additional return that you will get is the green part of this graph, right? So in the first 5 years, there's a very small difference between the white level, which is what your fixed deposit gives you, and your green level, which is what your debt fund gives you, right? But as you increase the time duration, right? So if your ability to stay invested in a particular fund increases, and you choose a product that you can be invested in for the long term, then your tax deferring really works out excellently. So you can see that like over 15 years, even somebody in the 30% tax bracket is making a 4.5% post-tax return, right? Which is phenomenal for a low risk, no nonsense kind of investment product. So now moving on to the fourth question that we have, which is we've talked about fixed deposits. So it's natural to think about recurring deposits, right? So what about recurring deposits? Are they better, or should I look at something like a systematic investment plan or SIP? So the key SIP versus RD argument is that firstly, your SIP adapts to the market, which means that as since you're investing in a mutual fund, there is a mutual fund manager who's looking at the market and seeing where the opportunities are, what is the right place to sort of be invested in, and to capture the opportunities that are there on at that particular time. Whereas your RD is at a fixed return, right? Um, you have much better yields on the product side in mutual funds. So if we look at debt fund yields, they're all close to 7% and above. But if we look at the RD rates today, I think you're closer to 5%. So the difference is not 0.5% or 0.25% where you think that, oh, why should I not, why should I bother and make this switch? It's actually quite a big spread. So there is a lot of merit in for an RD investor to consider mutual funds as a savings vehicle. Now, the next thing is no exit load in SIP. So if you decide that firstly you have a greater penalty, you also have to pre-commit to a particular timeline. So you can't just do an RD according to what your goal is. If the bank is offering you a 2-year RD or a 5-year RD, that's what you have to end up sticking to, right? And on the mutual fund side, there are products that have exit loads, which means that they would charge you some fee for taking out your investments before a certain period. But by and large, there are enough and more options of great mutual, like very well managed mutual funds where there is no exit load. So on the whole, I think there is a lot of merit in considering SIPs and mutual funds as a vehicle to save and invest into fixed income, primarily because there are so many advantages compared to the other traditional options that are available. Now, I've answered 4 of the top questions that were there, and I'd like to hand over to my colleague Roshan, who's also on the call today, to take on the next few questions.
Sam, you can move on. Yeah. So another huge misconception that we've come to address is people thinking fixed income is easy, right? So a lot of fixed income funds. Sam, you can move on to the next slide. Yeah, so this is actually not the case, as you can see from the image on the presentation. A lot of fixed income funds actually did not survive the bank bond defaults, the DHFL and ILNS events in 2018, right? And also due to the liquidity issues that happened post-COVID in 2020, Franklin Templeton actually had to close 6 of their debt fund schemes, right? And also we've seen events such as debt fund categorization, taxes on MLDs most recently, and also the change in the norms for indexation, which doesn't exist anymore, right? So all of these pose quite a big challenge to the industry, and you do need an expert to navigate through all of these obstacles, right? Sam, you can move on to the next. Yeah, so this is one of the most common questions we get with respect to fixed income products, which is regarding bonds, right? So how do you think about bonds? Like, how should you go about investing in bonds? So the most crucial thing to understand about bonds is that most bonds in India, at least most bonds that investors come to us with, are pretty illiquid, right? And buying and selling these bonds, it's mostly done by dealers, right? So the dealers hold the pricing power, right? So does this mean that they're a bad deal? Absolutely not. If you know what you're doing, there's a caveat to that. It's not a bad deal if you know what you're doing. So the first thing you should do while evaluating a bond is to see the credit quality, right? So, and here it's not enough to just look at the credit ratings by CARE or ICRA or CRISIL. right? There are various other factors apart from the rating that impact the credit quality. So you should also look at the strength of the balance sheet for the company that you're investing in, the strength of the balance sheet, the track record of the company in paying their obligations, right? And the business climate of the company and the industry that the company is operating in, and if the company is like a service provider, the company's clients, right? And also the strength of the company's parent, right? So this is an if applicable situation, but if you're buying the bond or if you're looking at a bond of a subsidiary, it's crucial to look at the strength of the parent, right? So going hand in hand with this, the investor should also look at the bond's covenants, right? So what are covenants? So these are issue specific, right? So issue specific as in the issue of the bond that you're investing in. A lot of bonds, a lot of companies issue bonds at various points. And the rating and the covenants for these bonds might be the same or they might differ also. So that's another thing to look at. So the covenants are issue specific, right? And they divulge the details of whether the bond is securitized or not, right? So, and if they're securitized, with what sort of assets are they securitized, right? So all these details are divulged in the covenants. So that's another really important thing to look at, right? And then you look at the interest payments, right? So here we look at the return on offer, both the coupon and the yield, right? And after that, we look at the reinvestment risk that we're taking. So when evaluating reinvestment risk, it's important to take into consideration the maturity of the bond, or if the bond has a call option, in which case it's a perpetual, you can look at the year of the call, right? And you can consider that as a pseudo sort of maturity. It's not a one-to-one comparison, because when you're looking at the maturity of the bond, it's binding, right? Whereas with a call option, it's not binding. But that's the best you can do at that point in time, right? So that is the so when weighing in reinvestment risk, we should also look at the short-term and long-term rates, the broad market rates, and also the current point of the interest rate cycle. Where are you on the interest rate cycle? So that is also a very important aspect to look at. Right. And then it's always good to have a diversified portfolio. This holds true to any type of security. And it's also true for bonds as well. You can look at diversifying your portfolio. Next one. So aren't equity savings funds and arbitrage funds more tax efficient? So here we have a table. Sam, you can go to the next slide. Yeah. So here we've shown the 1-year post-tax returns for arbitrage funds, equity savings funds, and low duration funds, right? So these are all category averages. Investments in low duration funds and arbitrage funds are suitable as 1-year investments, whereas investments in equity savings funds are not, right? You should not be looking at a hybrid product with a 1-year view, but since we've had a lot of questions regarding equity savings funds as well, we've included that here. So this is just an illustration, right? So with regards to taxation, right, arbitrage funds and equity savings funds are taxed at 10%, right, for investments 1 year and older, whereas low duration funds are now taxed at a slab rate. So as you can see, for a 15% sort of tax bracket, until you reach the 15% tax bracket, the low duration fund has performed better, right? And post that, the other two have gone ahead. But for a 1 year sort of duration, you can either look at low duration funds or arbitrage funds, right? But equity is not a suitable option for a 1 year investment, because it carries inherent volatility, and volatility can only be curbed by staying in for longer. Sam, you can move on to the next. Right. So all that being said, right, is debt alone enough for someone to achieve financial freedom, right? So just investing in debt alone will not beat inflation by a significant margin. So when you want to beat inflation by a significant margin comfortably, you need an asset that will grow with the economy, right? And that's only equity can grow with the economy. Right, but equity is not for everyone, right? Some of us are risk averse. We don't like seeing too much volatility in our assets. So to you, I would say invest a small amount in equity and invest smartly. So invest like 20 or 30% in equity, but be smart when you invest in equity. Don't invest at any valuation, right? And also stagger your investments. Invest slowly, right? And invest and always invest when there's a correction and whenever there is a correction, right? So if you make these decisions, in addition to having a balanced portfolio, right, you can invest in equity without seeing too much volatility, hopefully, and improve on your returns. So Sam, you can the chart is not on display. Yeah. So in this chart, we've taken an initial investment of 7 lakhs, right? And for your traditional assets, we've compounded that at 5% CAGR. And for equity instruments, we've taken a pretty conservative estimate of 9%, right? And if you see over 20 years, the 7 lakhs investment in equity has grown to nearly 40 lakhs, right? Which is more than 5 times, right? Whereas for 5% CAGR, the 7 lakhs has grown to about 20 lakhs, which is a little bit less than 3 times, right? So equity can play a huge part in your long-term wealth creation. And please don't neglect equity just because you might be risk averse. Try to make small investments and smart investments in equity. That's what it's. Yeah, so with this, we now open the floor for questions. So you can post your questions on the chat box, and Samyukta and I will answer.
I think Mr. Satish Kumar has his hand raised, so I'll just unmute him. Um, Hi, sir. You can unmute yourself and speak. I think you've had your hand up for quite a bit of time.
Whether a mixture of asset classes is good, or if we concentrate on a particular asset class, it will be okay in long term.
So we'll go back to the slide that we had shared, right, with the asset mosaic, which means that uh, at different points in the market cycle, different assets can create wealth for you. So why miss out on that opportunity, right? Very few people actually have the capacity to work with only one asset class, right? We have some investors who will say that I'm a long term investor. I can afford to take a lot of risk. I don't mind if my portfolio is down for 2 3 years at a time, but I will invest only in equity. Now, if that is your risk appetite and you can afford to take that kind of risk and you can continue to participate in the markets, that is, if you don't have asset allocation, right, how will you continuously participate? Because if you have asset allocation, then when something goes has finished performing in your portfolio, you can channel those funds into the next into an asset class that's going to perform in the coming year or in the coming cycle, right? So unless you have that flexibility, I think it would always make sense to have some allocation across asset classes and not only focus on any one asset class, whether it's fixed income, whether it is real estate, or if it is equity, right? I think predominantly when investors choose only one asset class, it tends to be one of these three. We also have a question from Mr. Sarvesh. I think Roshan, you can take this. isn't NCD a better option where we can get 7 to 8% and we can choose our payments, whether it's quarterly, monthly, or yearly?
Yes. So it all depends on the NCD. So the first thing we should consider when considering an NCD is the liquidity, right? So if you might need the money before it matures, then what is the sort of hindrance you'll have to that, right? So that is one thing. The other thing is the term of the investment. Whether you want to make that sort of a long-term commitment, or if you have a shorter-term NCD, will you need a longer-term NCD, right? So that is another option that you have to consider. With regards to the payment structure, it all varies based on different NCDs. So you could come to us with an NCD that you're looking at, and we could definitely help you take a decision on that.
Yeah. Okay, I'll take Mr. Jagadishan's question. So if I invest in stocks, say TCS, should I not trade in them? I want to trade and also grow it in my portfolio. How to go about it? So to be honest, trading is not in our forte or our philosophy on how we approach wealth creation. We are completely long-term investors. So while we look at asset allocation, I think even for an idea to play out, it takes 2 to 3 years before you can actually see a particular theme, even at an asset class level, really perform, right? So we are not experts, and I don't think we would be able to actually assist you with that question. How do we view sovereign gold bonds? I think this is a good investment option, especially because of the change in debt fund taxation. So, definitely digital gold, whether it's in the form of a sovereign gold bond or an ETF or a mutual fund, is a smarter way for a modern investor to look at investments in gold. Because when you have physical gold, you are ending up paying a lot of other things that are not factored in, right? Like you have making wastage, storage, security, all of these kind of costs just pile up. Even if you're looking at coins and not jewelry, I think, or bars, in all of these cases, there are higher expenses loaded into your investment itself. And we are so conscious, right? We think so many times about whether you should go through a direct mutual fund or a regular mutual fund because of the difference in expense. That when it comes to gold, also, we should kind of apply the same mindset, right? And see what makes sense and where you're able to save more. Now, the SGB is a great option because no other form of gold investment actually gives you any income. The SGB is the only product where you get an interest of, I think, 2 or 2.5% per year that comes into the investor's account. So uh, definitely, whenever, and it's secured by the government, so all this safety, security, purity, all of those boxes get ticked immediately. And yeah, it's a great investment, definitely. Okay. Question from Mr. Ganesh Kumar. What are the pros and cons of investing in US equity markets through Indian mutual funds through the fund of fund route? I can take this. So I think probably on the pros side, firstly, you're getting exposure to the US market, which is otherwise now with your 20% TCS, etc. Like it might be difficult for a retail investor to really be able to get in the allocation that they want through a direct fund exposure that you might have. The second thing is that your fund of fund offerings are like you have a few offerings, so it's not that you're limited to only one or two ideas. But that being said, on the con side, typically whatever comes in the NFO side tends to be a hot investment, right? There is some hype around a particular idea, and then you'll see a bunch of global funds getting released in that particular category. So you need to be a little bit careful in terms of your own entry and exit. It's not necessary that something that comes as a new fund offering is going to be the best global allocation for you. And to a certain extent, I think this is not really a con, but it is something that an investor should be aware of, that there will be some differences in terms of exchange rates. There will be multiple layers of NAV movement that you have to factor in. So keep some buffer in your return expectation, right? Because there are many variables at play there. And you cannot look at a direct like, oh, if the US market has gone up 1%, that the same thing will happen in your portfolio continuously. But don't break your head and try to predict currency trends, because that's also very counterproductive and it will prevent you from making sensible global allocation decisions. Okay. All right. Question from Mr. Karthik Ramadas. Many people fear regular mutual funds compared to direct mutual funds. Can you please explain the pros and cons of this mindset? Roshan, would you like to answer this question?
Yes. So with regards to regular mutual funds and direct mutual funds, there is no broad difference except for the expense, right? And the reason why we see a lot of people going towards direct mutual funds instead of regular mutual funds is because of this expense. But the investor should also understand that these are not simple products, right? It's not like shut your eyes and invest sort of a product, right? There are few nuances when it comes to mutual funds as well, right? Not only is it only for like direct equity investments or like a larger PMS or an AIF. People should still be aware of what they're investing in and how they're going about it, right? So the reason for this mindset mainly is because mutual funds have been simplified to close your eyes and forget it kind of product by social media and things like that. We don't think of mutual funds as a big deal, but in reality, they are a big deal. They can really help you grow your wealth, right? And they are pretty complex products. So that sort of a mentality plays into the fact that, oh, why should I pay extra for a regular mutual fund, or like the advice that comes along with it? Why not just go to a direct mutual fund? If the investor knows what they're doing and has experience, then yeah, for sure, direct funds make sense, right? Or if you're investing through an advisor, right, direct funds make sense. But for others, I think regular mutual funds are still the way to go.
Yeah, and just to add to that, right? In both cases, the underlying portfolio is the same, like Roshan mentioned, and the key difference is only going to be on the expense side. Now, a lot of investors who are cost conscious think that, okay, you know what, if I can choose the mutual fund, let me save on that additional expense that I would give to a distributor. But the thing is, there is no good mutual fund research in the industry, right? You have people who do stock research, you have people who do stock analysis. There is a lot of crowd on social media also who shares these kind of information. But on the mutual fund side, you really don't have anybody who's doing solid research and putting it out there on a public platform. So what is it that actually gets sold? Wherever you're transacting in direct, right? The platforms have a certain algorithm or certain recommendation on what is a top performing fund. And the disclaimer that comes in every mutual fund ad is that past performance cannot guarantee future performance. Yet people use that as a framework to choose their investments. Now, if you're not going to do more due diligence than that, right? If you're going to go with what somebody has said is the top fund, and you're just going to look at 1 year, 3 year, 5 year performance and then make your investment decision, then I think, there is a lot of thinking that you have to do about what is best for your wealth creation. And paying that little bit extra to a distributor is not really going to harm you in terms of wealth creation, right? Because ultimately, the key is that you should earn the return that you're capable of earning, and you should not cut out on that potential because you're worried about paying 0.5% or 1% as distribution fees. Now, if you're So compare, like let's say you have a mutual fund distributor who's doing it in regular versus an investment advisor who's going to advise you under the direct option, right? Then at that point you can compare the fees and see, does it make sense for me to look at a regular plan with a distributor, or does it make sense for me to look at a investment advisor who's doing it under the direct plan? So I think that is where you should apply the comparison. And if you're going to compare it to what you're capable of doing, also think about how much work you are putting into fund selection versus how much work the distributor is going to be doing, right? That becomes a fairer comparison. I also think Miss Jayalakshmi has been having her hand up for some time, so I'm just going to unmute you, ma'am. Please please go ahead and tell us your question.
Hello, hi.
Hi, ma'am.
Yeah, I need to know about that UP Power Corporation bonds which is available in the market. Is it safe for investing, or
I
your
think
view
we
on that?
I think we can take fund specific or security specific questions offline and in person with your point of
Okay,
contact. Yeah.
okay, okay. So, tell me about the bonds generally for investment. Is it safe or risk associated with it?
So I think Roshan had covered a lot of this in that one
Okay,
slide, right? When we are picking
okay,
a particular bond, what are some of the things that you should look for? So who is the issuing authority? Like who is borrowing this money from you? In the case of UP Power Corporation, that's the entity, and they are backed by the Uttar Pradesh government. So there are certain covenants that you will have to see. Is this bond guaranteed? Is it not guaranteed? Is it a secured bond? Is it not a secured bond? What is the credit rating? What is the balance sheet like? How have their cash flows grown in the last few years? So it takes a lot of analysis and reading to understand whether something is a good investment or not.
okay, okay. Thank you.
Okay, you're welcome, ma'am.
Okay, I'll take this. Okay, so the question is, can an ETF be chosen in place of index funds in the Indian context? Okay, so it all depends on the ETF, to be honest. So one of the most important things you should consider in an ETF is the liquidity of the ETF. So in our experience, some ETFs are pretty liquid, in which case you can just click buy at current market price, and you'll get your allotment. Whereas some ETFs are sort of illiquid. So with that aspect, you should be a little bit more careful. But in the broader sense, as the market grows, you will have more liquidity in more ETFs. And at that point, yes, ETFs will be a very good option for an investor to invest. What are the merits and demerits? Okay, I told you about liquidity just now, and another thing, another important thing to keep in mind is that to buy an ETF, you need a demat account. That is compulsory. Whereas for an index fund, you don't need a demat account. So that is also another point.
Okay. The next question is, how do you plan between wealth creation versus target-based short-term investments, say yearly targets? Is it advisable to take risky investments for short-term targets? So firstly, in the short term, if the priority is to meet the goal, there is no point in taking any risk, right? Is it really worth that extra 1% or 5% if there is a downside chance that you will not meet the goal, right? Let's say you have a child who you're sending to school or college. Do you really want to play around with that money just so that you might get an extra something with a different investment? Mostly it does not make sense, because what is more important is the goal than the actual return that you earn, right? uh, Now if you have a very flexible thing, like let's say in your mind you want to do something in 1 year, you want to take some risk, see how that goes, that is totally your call, right? Each person's risk appetite is different. Their ability to withstand loss is different. Their ability to deal with not meeting a target in a particular year is also different. So I think that's a personal decision that you will have to make. But by and large, it's not advisable to do these things, because for most people, goals that come within 1 year are priority goals. They're not things that you can really shift the goalpost on and say that, okay, I'll do it next year, right? Or it's fine if I delay it by another 12, 18 months. And if you're looking at balancing between wealth creation in the long run versus your shorter term goals, it's important to have something that is long term. And shorter term goals, sometimes we can control them or cut them down if they're eating into our capacity to save for the long run. Sometimes we may not be able to. So in those situations where you have short term priorities and long term wealth creation on your plate, I think at that point it's best to approach somebody like a financial planner, talk to them, see how you can actually prioritize different things and space them out, because that whole exercise of planning will give you some clarity on what you should do and how you should tackle each of your tasks. Okay. Question from Mr. Mai Prakash. What is the percentage of exposure to T-bills and G-Secs? Again, I think that's more of a risk appetite based question, right? Because both treasury bills as well as government securities are issued by the government. So it's a zero risk uh, investment from a credit perspective, meaning there's never going to be a situation where you don't get repaid, right? But if you have longer term government securities, you might be having some level of duration risk which you need to monitor and manage. So again, based on your requirement and your ability to take risk, or why you're investing in fixed income, you need to decide that allocation with uh, with either yourself or with a professional, whoever you are working with.
I'd like to add to that. So if the question is coming from purely interest in investing in T-bills and G-Secs point of view, most of your shorter end funds like liquid fund, money market fund, a lot of them have T-bills in them, right? And also your overnight funds have T-bills in them. And a lot of your fixed income funds also take exposure to G-Secs. So you can get your exposure through debt mutual funds as well. If that was your, like the interest of investing in T-bills and G-Secs was your point of the question.
Okay, another question from Mr. Ganesh Kumar. What are the ways to manage NPS schemes, allocation percentage in equity versus bonds and others, effectively during its life cycle? So I think with NPS, there are two options. Either you can choose the allocation, or you can go through an automated allocation that will decide how much exposure you would have to equities, corporate bonds, as well as government securities based on your age. Now, if you are going to be choosing that percentage on your own and you're not going through the automated allocation, then there are few factors that you should consider. So you should consider what is your timeline to withdrawal from NPS, where are you in the market cycle, and then within the NPS you have multiple scheme options, right? So within that also you should decide which of the NPS funds you would want to invest in. Similar to sort of picking a mutual fund, there is a lot of due diligence that goes into this process. And the percentage is not always going to be fixed and is not necessarily going to be the same for two different people. So that is, I think, the framework on which we have to make that NPS decision. All right. I think we have one question from Ms. Vasanta Kumar. In wealth creation, we have to plan PPF, mutual funds, and equities, or only do mutual funds. Roshan, do you want to take this?
Yeah, sure. So the answer is no. You should have so all of the products that you've mentioned here, they're all part of they should all be part of your wealth creation basket. But the time at which you plan for each, that will vary. So for example, you take a higher risk product and invest more in a higher risk product when you're earning and when you're younger, right? And as you age closer to retirement, you can plan on more, like lower risk products and, go about that way.
Yeah. Also adding, I think, see, the advantage for a investor with respect to mutual funds is you can do any amount, right? If you're able to save only a few thousand rupees or even 1,000 rupees in a month, then with the mutual fund you can get exposure to all of these asset classes. Whatever PPF is offering you, you will get in terms of like a debt fund. If you want to invest, if you want exposure to equity, right? Now, let's say you want to buy a particular stock and you're saving few thousand rupees every month. It's difficult to buy larger allocations of stocks with that kind of money. But when you buy a mutual fund, you're getting a whole portfolio of stocks, and all of them could work for you based on whatever fund you are choosing, right? So I think from a saving perspective, it's really nice for an investor to have exposure to mutual funds because it opens up a lot of doors in terms of what you can do with your savings. But if you want to do investments like PPF and you want to do other investments also that are there in the post office or that the bank offers you, or wherever you're finding a good investment, right? Whether it's NPS, PPF, all of these things, I think definitely you can do it. It's not that you have to do only one or the other, right?
Okay, I can take the next question. When we consider pure long-term wealth creation, what are the factors to be looked at during stock selection? Okay, and what should be the stock performance review frequency? Okay. First thing, just because we're investing with the aim of long-term wealth creation, we should not, go by investing in any sort of security or stock or mutual fund or sector or anything, right? So primarily, we should look at, the valuation and how the economy is growing, the climate, the business climate, I meant, all of that, right? And and invest in what you're comfortable in, right? Take um, uh, don't take too much amount of risk, right? Like with equities, a fair amount of risk is involved, but don't overdo it. Like don't invest when your stocks are at an exorbitant valuation. And also another thing that you should look at is to book profits now and then, right? If you feel like a security has gone up like gone too fast and in like a very short amount of time, right? Look to book a little bit of profits and then reinvest that somewhere else where you find the opportunity, right? And that is another aspect. How often should your review frequency be? So every month is too high a frequency. You should not be doing that. Every quarter is okay, pretty reasonable. Every half year is also pretty reasonable. So I would say anywhere between like quarterly and half yearly should be your review frequency. But every time you make a decision, it should be based on the overall portfolio. That is also another thing that you should look at.
Okay, we still have a few more minutes, so if there are any more questions, we'd request you to please type them into the chat box and we'll be happy to take that. I think someone is typing. We'll just wait for them to finish and probably take that question. You're welcome, sir. You're also welcome, ma'am. Thank you for joining us today. Uh, I mean, we really enjoy doing these kind of interactions with investors. And if you all have specific questions, or if you think that we should do some particular webinar addressing certain aspects of personal finance, we'd be like very happy to do that for you. So we're always looking forward to your feedback and your inputs on what is useful for you and how we can actually help you in this journey towards wealth creation. Uh, so I think we probably don't have any more questions. So thank you everyone for your time. Thank you for listening in to us, and we hope we were able to help you with your questions. And if you have any suggestions, feedback for us, please share it with either me and Roshan directly. These are our contact details, or if you're in touch with someone else from the iThought family, please let them know, and they'll also be happy to talk to us. So thanks a lot, and see you all soon the next time we do a session like this. Thank you.
Thank you, everyone. Have a great weekend.